Good afternoon, and thank you for joining us today for the mid-year review and update on the International Equity Strategy with Portfolio Manager Dick Hirayama. Mr. Hirayama has been the lead manager for the International Equity Strategy since its inception in 1995 and has over 44 years of industry experience. During today's call, we review the portfolio's investment thesis and examine the drivers behind the portfolio's performance year-to-date through June. Following this, we will discuss the current positioning of the portfolio and its long-term supercycle positioning. Lastly, we hear Dick's outlook for the portfolio for the rest of the year. Following the conversation with Dick, we'll hold a brief Q&A session. Questions will only be taken through the chat function on your web browser. To submit a question, you can click on the red Q&A button at the bottom of your screen at any time throughout the presentation. With that, I'd like to welcome Dick Hirayama and thank him for joining us this afternoon.
Thank you, Brian, and welcome this afternoon. I'll spend a few minutes on the strategy overview, a few minutes on our second quarter performance, and then thirdly, we'll cover the current environment and future prospects, and then questions and answers to conclude the presentation. So if you have the slide presentation in front of you, slide 3, just a brief comment on our strategy. Our WHV International Equity Growth Strategy utilizes a global macro top-down investment approach. We seek to identify long-term secular growth trends or supercycle trends that have the potential to persist for years, if not decades. Slide 4. If we viewed our world from a satellite 1,000 miles above the surface of the planet, we could see that the most dominant trend that spins the world every second of every day is global capitalism. In its tenacious drive to increase profits, global capitalism favors the lower-cost regions and countries around the world, which in the current new millennium are the emerging market countries. The BRIC countries, Brazil, Russia, India, China, Indonesia, etc. Since 2000, the lower-cost emerging market countries have been growing at 2 times the growth rate of the higher-cost developed market growth rate, and this superior growth of the emerging markets is expected to continue for the foreseeable future. Thus, the emerging markets have been and will continue to be the world's growth engine. However, unlike the United States, Europe, and Japan, they are not service-oriented because they are too poor, primarily because they have too many people, 6 billion people on the planet, and thus they have to engage in industrialization if they are to grow and raise the standard of living of their citizens. Europe, ourselves, the United States, Canada, and Japan launched the first great industrial revolution during the 19th and 20th centuries, and now the emerging markets have engaged in the second great industrial revolution in our 21st century. And this is a major secular trend that can last multiple years and decades. As a developed market equity manager, we have designed our portfolio to exploit the superior growth of the emerging markets by investing in sectors, industries, and companies that would be expected to benefit over the long term from the emerging markets' industrialization, urbanization, and infrastructure modernization phases. The emerging market scale of industrialization is so humongous, with 6 billion people of the 7 billion on the planet, that they are short of energy, materials, industrial products to fuel their industrialization and must rely on imports to satisfy their requirements in order to grow at over 2 times the rate of the developed markets. We, as a strategy since 2000, have invested in energy, materials, industrial, and consumer companies that either sell their goods directly to the emerging market countries or provide goods and services indirectly to industries that export to the emerging markets. Slide 5. A major macroeconomic characteristic of our energy, materials, and industrial sector investments is that they are economically sensitive and perform better when global real GDP growth is accelerating, and the economically sensitive investments perform less well when global economic growth is decelerating, which was the case since 2011. As you can see on slide 5, when global real GDP growth is ticking downwards, if you see it in color, it would be a minus on the third column or red. That tends to be a headwind for economically sensitive investments. However, when it's green or positive, that's a tailwind, and this year there has been a tick up in the global economic growth, which has been a positive for us, and the IMF expects economic growth for the world to continue to accelerate into next year. And now focusing on our performance during the second quarter, we performed quite well during the second quarter of 2014, as well as the first 6 months of this year, as the strategy benefited from improved economic climates in both the emerging markets and the developed markets, as shown on slide 5. Contributing to our outperformance were our 2 Canadian railroad transportation companies in the industrial sector, Canadian Pacific and Canadian National Railway, as they benefited from a stronger North American economy, as well as increased rail car loadings for the export market. And if we can just skip a few slides to slide 8 to hit on the weakest performers. The weakest performers during the second quarter were our metals and mining companies and the material sectors, because global growth had been decelerating. China was a little bit weaker. The emerging markets had been weaker earlier in the year. However, in July, the emerging markets and China's prospects have been improving, and as it turns out, in July, the metals and mining companies in the material sector are recovering sharply and are one of the leaders in the marketplace, at least for the start of this quarter. China did not disappoint and reported a 7.5% growth rate for the second quarter, in line with the government's target for the year 2014 to 7.5%. So they managed to hit their target. And the 7.5% growth rate is, as you can see from the previous slide, more than double the world's growth rate of 3.4%. So China is, being the second largest economy in the world, continues to be the major large growth leader of the world. Now if we skip to slide 9, continuing on the attribution for our second quarter performance, which is our second quarter performance is one of the best in the industry, led by the energy sector, which led both the international and global markets, as the oil-rich EEMEA region, Eastern Europe, Middle East, and Africa, was struck by recurring destabilizing geopolitical forces. Initially, it was impacted by the crisis in eastern Ukraine and Russia, when Russia invaded Crimea and annexed it, and then created more havoc by providing weapons and support to eastern Ukrainian rebels. And so that was the first major crisis in the region. Russia is one of the largest oil producers in the world, and so there's a question as far as Russia being able to continue to produce at their current rate, considering the fact that potentially oil and gas companies may question whether they should continue to invest in Russia. Then following that was the invasion of the Islamic State of Iraq and Syria, ISIS, from eastern Syria into western Iraq, and that also caused a major crisis, another major crisis in a major oil-producing region. If we flip to slide 10, before I forget that, let me just mention that we are not peak oil theorists. There's an enormous amount of oil in the world, and we will not run out of oil over the next half a century at least. However, it's in the wrong places. Over 80% of the world's oil is controlled by state-owned or state-controlled entities in OPEC, the Organization of Petroleum Exporting Countries, including Saudi Arabia, Iran, Iraq, Nigeria, Venezuela, and many of those countries are unstable or in unstable regions or are anti-West, and that's a major issue when trying to produce oil at a low cost, and that's a major problem that prevents supplies from coming on stream as they should. And coming back to slide 10, in the media, there's a lot of attention on the tremendous growth rate of oil production in the United States, primarily from the oil shale regions of North Dakota, Texas, Oklahoma, Ohio, etc. And true, our production of oil, and also offshore Gulf of Mexico, our production of oil is increasing significantly, and you can see that it's been climbing up 2 million barrels a day. The world produces and consumes about 93 million barrels a day. So you can see that as for a reference. However, what the media hasn't considered is the fact that although production of oil from the United States, Canada, and Brazil have been significant since 2011, it has been totally neutralized by production shortfalls from Iran, Nigeria, Libya, Syria, South Sudan, Yemen, Angola, and other countries. So the prognostications that higher oil production from the United States would be to the detriment of the oil price has not become a reality. And so if we flip to the next slide, 11, coming to current events, as you know, the issue with Russia and eastern Ukraine and Iraq has been in the front pages of the papers quite often this year. And the energy participants are quite smart. They realize that even though you had this crisis in eastern Ukraine and Russia, and as well as in Iraq, current oil production from either Russia or Iraq will continue to be at the same level as before the crises. And so, as you can see in the top left chart on slide 11, that the European Brent North Sea crude oil spot price, or the current price, initially went up and then has come right back down because the market participants realized that there is not going to be a shortfall in oil production from these dual crises. However, in the lower left panel, which is more important, is that market participants are now considering that these recurring crises in these major oil-producing countries might cause oil and gas companies to reconsider how much they are investing in those countries. And because of security reasons, issues with which government will be in power when the oil and gas company ends up completing their investment project a year or 2, 3 years from now, will a new government come in and ask for a bigger percentage of the profits, a bigger percentage of ownership? And so all these new uncertainties have caused the future oil price, and what we're looking at on slide 11 is a 5-year forward price, to increase this year by approximately 12 or 13%, compared to the spot price being down 2 or 3%. And our energy holdings have led our portfolio upwards during the second quarter and also for the 6 months of this year, because investors are looking at the lower left panel and not the upper left panel, because in terms of energy equity valuations, the long-term price is more valuable than the short-term price, because in the case of, let's say, Suncor, one of our Canadian exploration production companies that's one of the bigger oil sands producers of the world, the Brent price only gives them income for 1 day, the spot price. But Suncor has oil sands reserves going out to possibly 30, 40, 50 years. So what's more important to the valuation of Suncor is the oil price going out over the long term. And as we can see, the long-term price, at least for the 5-year forward price, December 2019 futures price, has risen dramatically this year, which enhances the value of our exploration production companies, and it also enhances the value, we feel, of our oil service companies, because with a higher long-term price relative to pre-crisis times, the oil and gas industry will most likely spend more money drilling and exploring for oil and gas than they had previously planned, of course, outside of the regions that are in conflict, Russia and Iraq. So slide 12, our portfolio structure has been relatively similar since 2000. After we sold all of our tech and telecom stocks near the peak of the market, the tech boom in March of 2000, we have overweighted the energy, materials, industrial, consumer staples companies, because we feel that this super cycle trend, which has lasted now a decade and a half, we expect to continue to lead the market and economies forward.
Great. Thanks, Dick, for your insight on the portfolio and the quarter and year-to-date periods. You talked about the current super cycles, and the portfolio clearly has large macro themes that tends to emphasize. I was hoping you could briefly discuss your overall global outlook for the remainder of the year.
Well, Brian, on the first bullet point on slide 13, accelerating global economic growth is very important, not only to the global economy, but to the global stock markets, and also to the relative performance of our portfolio. And potentially that could be a big boom if all this accommodative monetary policies by the United States, Eurozone, the UK, Japan come into fore and generate real GDP growth, and that could cause the real economy to really pick up steam. The global economy has only been advancing at a sluggish or tepid rate, but if we look at employment data, especially in the United States, and the fact that the Federal Reserve of the United States is tapering their bond buying, it's because credit demand is increasing, loan demand is increasing, and that indicates that, at least for the United States and potentially for the rest of the world, that the real economy is starting to stand on its own 2 feet rather than relying on money printing. The second point is that the central banks of the developed markets, the U.S., Eurozone, Japan, want higher inflation, because deflation is the major no-no, because with deflation you end up with a very destabilizing economy. So this is a problem, especially for the Eurozone and Japan, and both regions want higher inflation, and in the U.S., Janet Yellen would like at least 2% inflation because inflation means that consumers and businesses spend earlier, accumulate inventory, and therefore the U.S. economy will be stronger and generate more sales and therefore create more jobs. And so inflation is a positive as long as it is moderate. And so the major developed market regions, the U.S., Eurozone, and Japan, would like more inflation, but if it gets out of hand and the Federal Reserve underestimates how much inflation pressures are going to come on stream due to all the money printing, we would tend to benefit more than the benchmark because energy, materials, industrial investments tend to be more of an inflation hedge versus the benchmark. The third bullet point, China is always important to the growth of the emerging markets and also for our portfolio. And there were issues regarding can China continue to grow at a substantially above average rate, 7.5%, with its structural problems of their housing market and huge credit creation during the early years, but China continues to grow at an above average rate because they have to continue to create jobs, otherwise their unemployment rate will rise and they will have instability, which the leaders do not want to see in their country. And if their economy slips too much, the federal government has $4 trillion in foreign exchange reserves, which they can use to support their economy. In addition, since they have been fighting inflation early on since 2010, their inflation rate is moderate at 2.5%, and so they have a flexibility to stimulate if both fiscally and monetarily if they need to stabilize their growth at 7.5%. And the last bullet point, the unresolved situations in the EEMEA, Russia, Ukraine, Iraq, pushed the geopolitical risk premium for oil up, and market participants do not expect the price of oil to be much changed currently, but market participants are expecting that this is going to impact future investment in Russia and Iraq. And even though Russia and Iraq are major oil producers, their oil fields are old and require a tremendous amount of investment to fight depletion and to spur on future growth. So if you think about keeping maintenance on your car, you have to change the oil in your car every 3,000 or 5,000 miles or whatever the auto company recommends. And in the case of Iraq and Russia, if you don't have continuous investment, the oil wells will become sluggish and their oil production will decline. Or if you're trying to drill new reservoirs, you need Western technologies to assist in developing those new fields. So Russia and Iraq may face a point that oil and gas companies decide to reduce their exposure because the security risks may be too high. And if we look at those two major oil-producing countries, practically every country, Western country, is involved in drilling, exploring, and developing oil. For instance, Russia, the British are there with BP and Royal Dutch Shell. We are in there with Exxon. The Norwegians are in there with Statoil. The Chinese are in there with China National Petroleum Company. And in Iraq, it's even bigger. Iraq is the second largest, holds the second largest oil reserves in the world at 112 billion barrels, only behind Saudi Arabia, and therefore you have practically every Western company in there drilling holes, For us, Chevron and Exxon. For the British, BP, Royal Dutch Shell. The Italians, Eni. The French, Total. The Norwegians, Statoil. The Malaysians, Petronas. The Russians, Lukoil. And again, the Chinese, China National Petroleum. So if these countries feel that they cannot provide security for their oil workers, they're not going to spend as much money, or they may even pull out. So these are the major risks for both Russia and Iraq, which may reduce their future oil production potential and therefore create a tighter oil supply-demand market for many years in the future.
Thanks, Dick. I think that painted a very strong picture of the overall position of the portfolio and a good look back, as I said, in the year-to-date period in the recent quarter. I think there's a few key takeaways that we'd like to emphasize at the conclusion of this presentation would be, one, global GDP is forecasted to grow, as you mentioned, by 20% this year compared to last year. Historically, this environment has tended to favor the portfolio's investments in more economically sensitive areas. Number two, China remains the world's fastest growing large economy, and we believe this growth will still continue to fuel demand for natural resources. Three, the current global political instability in many oil-producing regions around the world is very likely to result in an increased risk premium for the price of oil. And lastly, we still believe that the urbanization and industrialization of emerging markets and the globe as a whole will continue, and this should continue the trend that will benefit energy, materials, and industrial sectors. I think right now we've seen a few questions come in over the course of our discussion. We'd like to take some time to address those. The first one, looking at a few, focuses on a supercycle thesis. And kind of curious if you believe that the original drivers that got you into structure the portfolio with an emphasis in energy materials and industrials remains intact.
Well, Brian, we feel that the emerging market countries continue to generate superior economic growth relative to the developed markets, 5% this year versus 2% for the developed markets. And secondarily, they continue to be engaged in the second great industrial revolution led by China. But now, as you've read, that there's a new government in India that desires to industrialize and shift their economy from consumerism to industrialization. And this is going to take many years, if not decades, for India to convert. But if India, with its 1.2 billion people, start to industrialize, combined with China's 1.3 billion people, the super cycle can continue for quite a while, considering that those two countries aggregate have 35% of the world's population, and industrializing 35% of the world's population would be quite a task and a tremendous demand for energy, materials, industrials.
Great, thank you. An add-on to that, as I mentioned, been in the supercycle thesis and position the portfolio to benefit from this for 14 years. What would make you change this?
Well, Brian, we feel that as far as our sell discipline, as in case of when we sold all of our tech and telecom stocks near the peak in 2000, we're looking for 3 red flags: overvaluation. We do not believe that our current sector holdings or companies are particularly overvalued. They seem to be modestly valued relative to the market. The second point is that when these sectors become really hot, then the companies and CEOs become growth-oriented and start excessive capital spending programs, which end up bringing on tremendous future supplies which overwhelm demand, and then you have the boom-bust scenario like you did with the tech sector in early 2000, and we don't see that environment currently either. And the third red flag would be equity investors gravitate to, on a momentum basis towards hot areas, and obviously during 99 and 2000, many market participants gravitated towards the tech and telecom areas to such an extent that those two sectors ended up being 40% of the world's weightings in the S&P 500 or in other major world indices. And currently, energy, materials, industrials are relatively modestly weighted in the benchmarks. So we feel that our sector investments continue to be very good investments for the future.
Okay, thank you. There have been a few questions that came in that reference the low turnover in the portfolio. I was wondering if you could share your thoughts on that philosophy.
Well, as far as our low turnover rate, which is like 5% a year over the past 5 years, we feel that these super cycle trends are multi-decade in length, and I think in our previous quarterly presentation, we point out that for Japan and South Korea, their first industrialization phase each lasted 44 years. In Japan, from the end of World War II to 1989, when the Nikkei peaked, and in South Korea, from the end of the Korean War to 1997, when Thailand blew up and dragged down all the Asian tigers. China is 35 or 36 years into their industrialization, and therefore can grow for industrialize for many more years if they are truly following the footsteps of their Asian neighbors, Japan and South Korea. And India is 20 years behind China in terms of industrialization, with only about 33% urbanization rate, with China at 54% urbanization rate. So if you assume that countries can urbanize at the rate of 1% per year, China is about 2 decades behind. India is 2 decades behind China. And so China, once it starts to get its act straight, can extend the life cycle of the supercycle quite a few more years, if not decades.
Thank you. The world has clearly been a very busy place if you look at the events that have been unfolding in Syria, Iraq, Ukraine, Israel, and elsewhere. You hit on it a little bit in the course of your comments earlier, but there have been some questions about your thoughts looking forward and how it may or may not impact the portfolio.
Well, we feel that those two recent crises in the EEMEA region, Eastern Ukraine, Russia, and Iraq, could be major game changers. Then you have an arc of instability running from Russia down through Syria, Iraq, and down to Iran. And so this arc of instability can last a long time because you have sectarian conflicts, ethnic conflicts, and these unfortunate conflicts last many years, if not decades. And this could be a long-lasting turmoil, and just so happens that they are all in major oil-producing regions, which could reduce the future oil production growth of the region. Since, as you know, the Middle East is a big oil-producing region and also a major oil exporting region. The world's major oil exporter, Saudi Arabia, has more headaches because in the north, they have a 500-mile border with Iraq. In the south, they have a huge border with Yemen, the headquarters of Al-Qaeda of the Arab Peninsula, and on the eastern flank, they have their mortal enemy, Iran. And so Saudi Arabia has major headaches, and they've been spending more money building defense barriers, especially north along the borders of Iraq. So this turmoil in the Middle East can continue for many years. And as far as Russia is concerned, Mr. Putin seems not to be backing off and continues to fund and provide weapons to the Eastern Ukrainian rebels, and so that uncertainty also continues.
Great, thank you. Looking at the clock, I think we have time for about one more question. This one looks forward towards the rest of the year, and wondering if you could provide your thoughts on what you believe to be the single greatest headwind as well as the single greatest possible tailwind for the portfolio throughout 2014, maybe even into 2015.
That's a good question for the last question, Brian. The major headwind that I could foresee would be slower global real GDP growth. That was a major headwind during the previous several years. However, I think that if global growth, especially in the developed markets, start to slide, that would motivate the central bankers to print more money, engage in more quantitative easing. In Japan and maybe in the United States, the Federal Reserve might reduce its tapering schedule, and in the Eurozone, the central bankers and the European Central Bank may decide to finally engage in quantitative easing or money printing, which then over the long term would create, I think, more inflationary pressures. As far as tailwinds, the simultaneous acceleration of global growth in the United States, Europe, Japan, the emerging markets would be very bullish for the global stock markets and also for our portfolio, since that would mean that the global economy would finally be perking up at a robust rate. So the major tailwind would be a synchronized global economic expansion, which our economically sensitive investments should benefit from.
All right, thank you. It looks like we're running out of time for right now. Again, we apologize for unable to address any of your questions that came in. I assure you that a representative from WHV will follow up with you soon to hopefully address that. Dick, I want to thank you for your time today, as well as everyone on the line who joined in. Make you all aware a copy of today's presentation can be downloaded by clicking on the icons at the bottom of your screen. You may also download a copy of Dick's recent second quarter portfolio manager letter and an attribution commentary as well at the bottom of the screen. Also, please keep an eye out in your email for information on a replay of today's webcast will be coming across shortly. And feel free to contact anyone here or your WHV representative at any questions or anything else. Thank you again. Thank you for joining us.
Thank you very much.